Hello, everyone. Good evening. I hope you have been keeping well and doing great. Tonight, we're going to talk about yet another important topic of financial accounting. Still, financial accounting, the switch that we took from managerial accounting about a week ago. We'll get back to managerial accounting soon. Anyway, so tonight's topic is accounting for retail businesses. This is also called accounting for merchandising operations in many textbooks. So it depends on which author you follow. Accounting for retail businesses is from chapter 5. It belongs to chapter 5 of this book. This is, of course, the textbook that we are using at Alabama A&M University. So this video is primarily for my introduction to accounting students at Alabama A&M, Accounting 203. All right. So what do you mean by accounting for retail businesses or accounting for merchandising operations? You know what happens? US textbooks, traditionally, they introduce accounting more gently. So the first few chapters, like when you talk about accounting equation, journal entries, ledger, and simple, like single step income statement and a single step like simple balance sheets, we use mostly service company examples, like a doctor's practice, a surgery, a law firm, a consulting firm, or a vacuum cleaning or painting company, or like companies that do lawn mowing. So service organizations that do not deal in real commodities, who don't buy and sell stuff like goods. So then from chapter 5, we go a step up, a step further, and start talking about commodities, about merchandise, about companies that buy and sell real goods, like this one, like these, or any retail company, Macy's, for example, Walmart, Kroger. There are many in every country. There are a lot. Anyway, so accounting for retail businesses have some specific, some additional features. Number one, you're going to deal with inventory a lot, which in the UK or Australia, New Zealand, we call inventory. So inventory or inventory, whatever you call it, we are going to face it a lot when you deal with accounting for merchandising businesses. Number two, you're going to see cost of goods sold directly. You can calculate it as you go. You don't have to wait until the end of the period if you follow perpetual inventory system. All right, so I'll get to that soon. The two methods of accounting there. One is perpetual inventory system. Second one, the other one is periodic inventory system. All right, so apart from that, you're going to see shipping, you're going to see handling, you're going to see different types of invoicing, like FOB destination, FOB shipping point. You're going to see credit terms. Like when you go and see a doctor, you don't normally have to deal with or have to negotiate a credit term, like give me a discount of 2% if I pay you within 10 days. Or you don't have to deal with insurance because you're not dealing with a physical goods, a physical commodity. So there is no shipment necessary. So here you're going to see those invoicing, you're going to see insurance, freight, you're going to see returns of goods. If you go to a doctor's practice and receive a procedure or receive service, can you return it? So the sales returns, purchase returns, these things are new. These things didn't exist or weren't relevant up to chapter 4 when you dealt with service organizations. So the sales up to chapter 4, we don't even have an item called sales or sales revenue. We used to call it fees revenue, fees earned, like tuition revenue or subscription revenue. And you haven't seen beginning or closing inventories. You haven't seen cost of goods sold. You have seen fees income or some kind of income, some kind of a measure of income, and you have seen a host of expenses. So your typical income statement up to chapter 4 used to be revenue or fees income, any kind of revenue that you call it, minus all expenses. So no operating income, no operating expenses as such. We used to, a doctor's chamber can have operating expenses and non-operating expenses, but that kind of classification is not promoted up to chapter 4. So tonight, from this point on, for several chapters, you're going to see the dealing in real commodities. You're going to see, as I said, cost of goods sold. You're going to see beginning and closing or ending inventories, and returns in particular. And you'll also see prospective, estimates for prospective returns and estimates for the cost of goods that we are expecting to be returned. So those things are also relevant and are also going to be accommodated here. All right, so the accounting issues that I'm going to deal with tonight in this video include the following. So here is a list. You can see the first page of the 2 pages that include the issues. So what do you see here? If I can go over: purchase of merchandise, purchase returns, shipping, invoicing, sale of merchandise, sales return, purchase discount, sales discount, stock take for periodic inventory system, then perpetual and periodic inventory systems. You can see a long list of accounting issues. All right, so this is what we have in our plate tonight, plus this. It's not over yet. Don't get scared, don't run away. So this includes collection of receivables, like when you sell, then you, at some point, you'd like to collect your money, you'd like to collect your sales revenue, and cash refunds for returns, then credit memo, or credit and debit memos for returns, depending on whether it's a purchase return or a sales return, then end of period adjustments for inventory shrinkage, or overage if you're lucky, then customer refunds, allowances, returns, credit terms in particular, discount rate, discount window or discount period, and credit period or credit window. So credit terms such as 210 net 30, as you can see here, 210 net 30 or similar ones. Then gross and net methods of recording credit sales. So that's also that's some. I mean, the list here is not necessarily going to be what we're going to follow in ordering it, because I have, mostly we're going to follow this order, but we could deviate when you talk about the issues. So although it looks like a lot of issues, but it's going to all boil down to several or a handful of things. Perpetual versus periodic. So that's the main discussion tonight. Perpetual inventory system versus periodic inventory system, how they work and why one is better than the other, or why one suits some companies better than other companies or than the other method. Perpetual versus periodic inventory system. The chapter primarily focuses on perpetual inventory system and then adds an appendix to deal with the periodic system. But I put in my slides, I tried to put them side by side so that you can see the accounting treatment under the 2 methods for the same transactions. Then you're gonna we'll boil down to, as I said, issues like FOB destination, FOB shipping point, the treatment of freight, the treatment of prepaid freight, if freight is paid by the seller in advance and added to invoice, or if it is not paid by the seller, if it's rather paid by the buyer. So those are some of the important issues. And the final issue, the final, I would say, vexing issue is the issue of returns. How do we account for sales returns versus purchase returns? And at the outset, I'd like to let you know one very important thing is that for every sale and sales return, remember, for every sale transaction and every sales return transaction, under the perpetual inventory system, you're going to have 2 journal entries each. So 2 journal entries for every sale and 2 journal entries for every sales return under the perpetual inventory system. Under periodic, there is never going to be 2 entries for anything. You'll always have 1 entry for 1 transaction on the periodic. So that's the big difference between the 2 methods, the 2 systems. All right, now a little bit about the 2 systems. The periodic inventory system is what we used to know for a long while in accounting, periodic inventory means when you sell goods, you keep selling goods and you record them as sales, and don't worry and don't record the cost of it. So when you sell, for example, a bottle of drink, let's say you sell it for $1.80, but you bought it for maybe 70 cents. Under periodic system, your accounting is only for the sale. So you have a sale, you debit accounts receivable or cash, and credit sales revenue for $1.80. Then you sell, say, an apple, you sell it for 10 cents, so you debit cash and credit sales revenue. But under perpetual, you record every sale as an independent sale. So you keep perpetual record of the sale as well as the cost of it. So under perpetual, you're going to have two journal entries, as I said, for sale, for every sale and sales returns. You're going to record it as debit accounts receivable or cash, depending on whether it was a cash sale or a credit sale, and then credit sales for the $1.80, and then the 70 cents, the cost of the bottle of drink would be recorded as debit cost of goods sold and credit inventory. In other words, you're recording, you're tracking your inventory ups and downs as every item is scanned out of through the outlets, through the checkouts. Sorry, not outlets, through the checkouts. So under periodic, for example, you don't record the costs. You still keep selling. You sell, and you scan, whether you use scanners or you use digital, non-digital methods. It's up to you, but you do not record the cost. Now, who are more likely to apply the perpetual versus the periodic one? I find that companies whose items are distinguishable, items are usually big or significant in nature, and items are few, like a designer clothing store, a designer jewelry store, or a designer watch store, like designer watches. You can see, although my one is by no means it's a designer watch, it is a very inexpensive watch, as a matter of fact. But if you happen to have, say, expensive watches, say Patek Philippe or Rado, or what's the other good ones? Rolex. Yeah, see, I keep forgetting. So if you have, say, sold one Rolex watch for $15,000, and you know the cost of it was maybe $11,000, so it is worthwhile recording each one independently, because you need to know which one is sold and which one is not sold. If you have houses, if you have, say, racing cars, or if you have even some exotic animals like horses, although to many of you, a horse may not be exotic, but let's say I have only 3 racing horses that I'd be selling over the next couple of months. So my one of the ones is, say, called Zebra, another is, say, Jordan, another could be say Kingston. So when I sold my Jordan, I know that my Jordan is sold. One of my horses is already sold. Then I go to my Kingston or my, say, Mayfair, or whatever you call. I'm I'm looking for interesting names. But the question is, you have 3 horses. They're very easily distinguishable. And when you sell one, it's you want to keep record, update your inventory as, Jordan is sold or Kingston is sold. Likewise, you have houses, for example, you have 3 houses or 40 houses, or 5 different cars, 5 different, as I said, expensive designer cars or limited edition cars, vehicles. So it makes more sense for you to apply the perpetual inventory system. While on the other hand, a company who is selling groceries, for example, bags of sugar or breads, bags of breads, or then one is not any different from the other. And what's the point in recording the sale price and the cost price of each one? But the textbooks tend to say that with the advent of information technology, we now have, you can see, we have scanning facilities. So every item is coded with a barcode, and as soon as it goes through the scanner, you can have a real-time account. You can have a real-time accounting or real-time record of the fact that the item has been sold. So you can actually update your inventory or as you go. So you'll have a real-time record as to how many more bottles of Powerade I have, how many more cans or bottles, whatever you call it, of Powerade I have in my stock. And that helps inventory management a lot. So it's not, modern scanning technology is not just about accounting, it's about inventory management. It's about efficient shelving, efficient presentation, and how best you can boost your sales, make yourself more profitable, make your customers more satisfied, make it more convenient and fun for your shoppers. But I think as far as accounting is concerned, perpetual inventory is more for the companies who have distinguishable items, whose items are of high value, like you know, um, whose big ticket items. See, these are important terminology that you have to remember when you talk about things nowadays. So the big ticket items. Now, a tomato is not a big ticket item. A bag of rice or a dozen of eggs is not a big ticket item. So for companies who deal in these items like groceries or thousands of batches of items, I don't think they need to apply the perpetual inventory system. But nevertheless, anyone can now use anyone can use any of the methods and will not limit the choices. So companies have the right to choose whatever method they like. But the features, my purpose is to explain the features, explain how the methods work, and explain the differences between the two methods, and make it really clear so that you can clearly see that the two methods are different and in what ways they are. So keep your eyes on a word called inventory. Keep your eyes on that word. That particular word is going to feature in one method a lot, and in the other method, it will not feature at all until you get to the end of the period, until you start preparing the financial statements. But in your journal entries, as you record the transactions, the word inventory is going to feature a lot in one of the two methods. The other one, it will not. So that's a big distinguishing feature, big symptom, big clue for you to know, to tell which method the company is using. All right, so we have seen the agenda. Now I'll start talking about the accounting cycle, the journal entries. Why I call it accounting cycle? Remember, in job order costing, I said there's a job order accounting cycle. So in inventory, even in process costing, I use the phrase accounting cycle, because there are a particular set of transactions that follow a pattern. So in accounting, in accounting for these merchandising operations, we have the same or similar pattern. So accounting cycle here starts with acquiring the goods. So purchasing goods, we purchase commodities, goods, stuff. Then we have purchase returns. We sell, we have sales return. We collect the payment. For returns, we make refunds. Sometimes we give cash back if the customer bought it in cash. If the customer has bought it on credit, then you give them a credit memo. So debit memos and credit memos are used for purchase returns and sales returns respectively, but cash is also going to be used in dealing with those returns. So that's a simple cycle. Just a few things. Just watch out. Do you know how to record a purchase under the two methods? How to record a purchase return? How to record a payment for a purchase? So I purchased something, I return the item that I don't need or that don't fit my needs, and then I pay for it. Then whether I pay within the discount period, was there a discount window? And if I pay within the discount period, there would be one amount. If I pay beyond or after the discount window is closed, then the amount is going to be slightly higher. So purchase returns, and payment for purchases. That's it. Then sales returns, and collection of sales revenue, collection of the sales price, or collection of the receivable. So that should be it. And then at the end, there are some adjustments for any shrinkage, inventory shrinkage, or for expected returns. And for expected returns. So those two adjustments are what you need to know. But if when we go through, so I hope you don't get too tired when you see a lot of or a lot of slides. There are going to be about 14 slides here. I hope you watch them slowly. If need be, pause and watch and see. All right, so the first transaction that we're going to see accounting for is a purchase of goods. All right, so you can see here, buy goods for cash. You can see. Clear, isn't it? Oh, I'm sorry. It's not too clear. So buy goods for cash. So that is the transaction. So what happens when you buy goods for cash? You can see under perpetual, we debited inventory because we consider the goods as an asset. So it's like we're buying an asset. So debit inventory, credit cash if you purchase on cash. So it's a buy goods for cash, debit inventory, credit cash. Under periodic, you can see debit purchases and credit cash. So inventory is the differentiating factor here between the two methods. Then you buy merchandise on account or buy goods for credit. So look at this one, transaction number 2. We're buying $3,000 worth of goods on account. So debit inventory again, credit accounts payable. Here debit purchases, credit accounts payable. You can see. Again, inventory is the differentiating word. So in perpetual accounting, we consider goods as assets, remember. So when asset comes in, asset is debited. In periodic, we consider it as an expense, like purchasing goods. So purchase is an expense or contra revenue because you have to purchase to sell, and sales is our revenue. So sales is a nominal account, purchase is also a nominal account. Under perpetual, we consider goods as assets. So when you acquire assets like real assets, if I bought a vehicle, I would have debited automobile, credit cash, or accounts payable or notes payable. So like that, we're going to treat any inventory, any purchase of inventory as an asset. So debit inventory in both occasions. Here you bought it for cash, here you bought it for credit or on credit. All right, transaction number 3 is the payment of freight. You can see pay freight in. Freight in means inward freight. So you are the buyer and you are responsible to pay the freight. All right, so it's like, if you consider, if you like to relate it to any of the shipping terms, it would be FOB, shipping point. So the seller has brought the goods up to the shipping point, and your job is to bring it to your warehouse or your location. So you paid the freight. So when you pay freight, again, we are debiting inventory, not any expense. We're not debiting an expense here. See, you're paying freight, but you're considering it as an asset. Very similar to accounting for long-term assets. When any cost associated with bringing the asset to its desired location and use. So all those so-called directly attributable costs are all capitalized. We're going to do that in chapter 9 in accounting for long-term assets or long-lived assets. The issue there is that you bought a computer, for example. So no one has a problem with debiting equipment for the price of the computer. But then you spent $15 to bring it home. Now, is that $15 an expense or is that an asset? Now, in strict terms, the $15 is not adding any value to the computer, is it? The computer is still the same. When I mean, if it was adding value, then why not you take the computer all over the state? Take it from one place to another, and have a tour of the country and spend like $5,000 more on shipping, and then load it all to the value of the equipment or the computer. So strictly speaking, payment of freight, payment of shipping expense does not add any value, real value to the asset. But it does add, in a sense, it's adding value because it's making it convenient for you to use it. So if a computer, for example, is inside a box, inside a carton. And if it's at the seller's warehouse, then I don't have it on my desk, so I can't use it. So I'd rather pay $15 to have it usable. So we call it directly attributable costs in accounting for long-term assets. So here, shipping is considered like a similar cost, and we load it to inventory under perpetual. You can say, so if you buy an expensive watch or an expensive jewelry item for say $9,000 and then pay $30 for shipping, then that $30 will also be added to the cost of the jewelry. Also debit inventory, credit cash you paid. Here, see, it's freight in. Here we don't call it an asset. We're recording it as an expense. Freight in, like inward freight. Now, outward freight for selling is an expense under both methods. Okay, so freight in is different. Freight in is recorded as inventory under perpetual and as freight in under periodic, but freight out is an expense under both methods. Just thought I'd make it clear. All right, so we've seen the first three transactions. Number one was a cash purchase. Number two was a credit purchase. Number three was payment of freight. Now, more on freight. Take a look at this. Here, freight is paid or prepaid by the seller. I'm sorry, I don't think you can, it's focusing it right. All right, so please read the transaction, read the details. It says freight is prepaid by the seller upon buyer's request and added to invoice, $30. So in most of these end of chapter examples and exercises and problems, you're going to see that. Say that yes, we're buying something for $1,000, then the freight, the seller has prepaid our freight and has added it to invoice. So what do? If they have added it, means that's adding to the value of my inventory. So debit inventory is correct. And now we haven't paid for it yet, so it's an accounts payable. You can see. So if the seller pays it for you, I'm having difficulty focusing. All right. So let's see, if the seller is paying it for you, then still debit inventory and credit accounts payable. Under periodic is the same freight in and accounts payable. We don't add it to the value of inventory. So inventory is the focal point here. How many things go into inventory? All right, so don't forget, prepaid freight is going to be added to inventory under perpetual system. Now, number 5, the terms include FOB destination, and now the seller pays for it. This is important. What happened here is that in the previous example on journal entry number 4, I said the seller is paying it for us. So seller was not, that means the seller was not originally responsible to pay the freight. You got it? Seller was not supposed to pay for it, to pay. We requested them, so to make it convenient for us, they paid for it. They did the packing. They brought the items to a carrier or a shipping company and delivered it to them, and have they have kindly done it for us. And we said, well, please add the cost to the invoice. All right, so it's of course debit inventory credit accounts payable. But if the seller was responsible to actually ship it to my door, up to my door, that means if the shipping terms included the words FOB destination. FOB destination means free on board. FOB could be, then it goes in two different ways. One is FOB shipping point, another is FOB destination. You're going to see both of them in the different, in different examples and problems. So if you see FOB destination, that means the seller was responsible to deliver the goods at their destination, which is the buyer's warehouse or buyer's location. Then of course they were responsible to pay the freight anyway. In that case, if they pay the freight, then that is their outward freight. The buyer doesn't have any accounting for it. The buyer is not responsible for it, and the buyer is not going to pay for it. So the buyer is not going to account for it. It's not a transaction for the buyer. You can see, on the other hand, the seller is doing a record here. The seller is doing the recording. Well, not here. The seller would be doing accounting for it. Although all these these transactions 4 and 5 are the buyer's transactions. But if the seller was to pay for it, and if it was their responsibility, then they would record it as freight out. So they would do debit freight out, credit cash, or credit accounts payable. You got it? I hope I didn't make it complicated, too complicated. The issue again is that part of it, there are two things here. One is, what was the shipping term? Was it FOB destination or FOB shipping point? If it was FOB shipping point, then it is the buyer's responsibility to pay for the shipping. But nevertheless, the buyer could negotiate it with the seller and have the seller pay for it. So when the seller pays it, we call it prepaid freight. That means they're paying it for you, but they're going to load it to the cost of the goods. So debit inventory, add it to the cost of the inventory, and credit accounts payable. If it is FOB destination, then of course it's not your lookout. You don't have to worry about it. The seller would be paying for it anyway. In that case, the buyer has no accounting for it, no matter whether you are using the perpetual method or the periodic. However, in this case, the seller has an accounting because the seller is paying outward freight. So we call it freight out, and it will be debit, it's the selling expense, debit freight out, and credit cash or accounts payable. Accounts payable, yes. All right. So that's our transaction number 5. Now the more real ones. Take a look. What does it say? Why do I lose focus? I don't know. All right, so please see the transaction. Okay, better put it close to you. Buy merchandise. Invoice price is $20,000. Trade discount 15%. Terms FOB shipping point 210, net 30. Prepaid shipping added to invoice $270. So a lot of information in one transaction. So please have the transaction under control. Buy merchandise worth $20,000. So the list price is $20,000. There's going to be some trade discount, some cash discount, and some prepaid freight. So 3 things, 3 important things: trade discount, cash discount, and prepaid freight. So let's first find out the total amount that we need to record. You can see invoice price is $20,000 minus the trade discount. 20% of $20,000 is $3,000. So that leaves us with $17,000 net of trade discount, and then take off the cash discount. We are using the net method here. We are assuming that the buyer is going to take advantage of the discount window. So they will take the discount. So take the 2% off. So 2% of $17,000 is $340. Once you take it off, net of cash discount is left at $16,660. Then you add the prepaid freight of $270. So please check the arithmetic here. Take a moment, check the arithmetic. You just have to use your calculator carefully. $20,000 minus 15% first, then whatever is left, take another 2% off, then add the 270 or whatever the prepaid freight amount is. So that gives us the final amount that we need to account for, which is $16,930. All right, now we have the amount. So what's going to be the entry? What is happening here? It says FOB shipping point. That means it was your responsibility to bring it. You means the buyer. So even though the seller has paid the freight, it's going to be loaded to the cost of the inventory. So debit inventory for the full amount You can see debit inventory for the full amount. For the full 16,930 and credit accounts payable. Under perpetual, the full amount is loaded to inventory. Well, by full amount, we mean the prepaid freight is added to inventory, which we expected. But under periodic, see, the freight is treated separately. Freight is an expense. So here we are recording debit purchases, and the purchase amount is going to be the amount before freight. This one, 16,660. $16,660 is your purchases, and then the freight is another expense, it's another debit, and then credit is the full amount, accounts payable. You owe the full amount to them. Got it? So here's a big difference between the two methods, but focus on the perpetual first, that we take off the trade discount, the cash discount, then add the prepaid freight. Load the full amount to inventory and credit accounts payable. On a periodic, don't load freight in to inventory or to purchases. Purchases is treated like a nominal account, as I said before, as an expense. Purchases is an expense, and freight in is another expense. We haven't paid for either, so the total amount is accounts payable. All right. So that's my transaction number 6. So keep an eye on this, because later at some point you are going to have returns associated with this transaction and also payments. We'll have to make the payments for it. So this number 6 will have to be settled at some point. All right. Now let's embrace a sales transaction. So we sold merchandise here. You can see sold merchandise for how much? $2,000. I'm sorry, losing the focus. I think I move my hands a lot, that's why. So sold merchandise for $2,000. The cost of those goods was $1,100. Now this cost information is relevant under the perpetual method. Under periodic, it's not even relevant. Under periodic, what's important is that you sold something for $2,000. So record it as a sale and record it for $2,000. Do not account for its cost. Okay? All right, so take a closer look again. And remember, I said that there are 2 occasions on which you're going to have 2 journal entries for each transaction. One of the occasions was a sale, and the other one was sales returns. Very important. Do not lose sight of these 2. Sales and sales returns. 2 journal entries each. All right, so here is your demonstration. So debit cash, it's the cash sales. So debit cash, $2,000, and credit sales or sales revenue. And then also debit cost of goods sold. You see here, you have debit cost of goods sold for the cost for the $1,100, and credit inventories, as if an asset is leaving you. The asset was worth $1,100. So you're receiving $2,000. So that's debit cash on account of sales. So debit cash, credit sales. And then you also have to record that $1,100 worth of asset is leaving you. So debit cost of goods sold and credit inventory treated as an asset. So cash sales is easy. You have the collection. You have no problem with any bad and doubtful debts or anything to make it complicated. Under periodic, debit cash and credit sales. Simple. All right. Now number 8, we're going to have a return. So we had a cash sales, and if there is a return, if the goods come back, some of the goods come back, then we're going to make a cash refund. So it's going to be simple. So what's the transaction? Return part of the merchandise or part of the goods purchased on number 2. Oh, sorry. So this is not a sales return. This is going to be a purchase return. So on number 2, we had a purchase. Remember, the purchase in number 2, was it a cash purchase or a credit purchase? I think that was a credit purchase. Yeah, number 2, you can see. Number 2 was a credit purchase. You can see buy merchandise on credit on account for $3,000. That is number 2. So part of these goods have been returned. So we're saying that returned part of the merchandise purchased on number 2. How much was it? $11,000, and received credit for it. Of course, you're not going to receive cash because it was not a cash purchase. So when you return it, if it was a cash purchase, you can expect a cash refund. If it was a credit purchase, you should be expecting a credit memo. All right. So return part of the goods purchased on number 2, and then the amount is $1,000, and received credit for it. So you tell me what's happening here? You're returning some goods. Under perpetual, some goods are leaving you. Remember, some goods are leaving, so it's like an asset. So there will be inventory. There will be inventory here. You can see that $1,000 of credit. Accounts payable is going down because you don't have to pay back the $1,000 if you return the goods. So debit accounts payable, and credit inventory, because inventory, an asset is leaving you, an asset is going out. Got it? And then under periodic, debit accounts payable. Debit accounts payable is okay, is common to both methods. Debit accounts payable, and credit is purchase returns. Debit accounts payable, credit, purchase return. Here, debit accounts payable, credit, inventory, not purchase return. So purchase return, 1 entry, not 2. Sales return will have 2 journal entries, but we're going to have inventory here. All right. So there's transaction number 8, which deals with a return of goods that we purchased in number 2. All right, now number 9. Please take a read. Number 9 says, return $1,000 worth of merchandise purchased on number 6. $1,000 worth of merchandise purchased on number 6, received credit for $1,000 before cash discount. And how you're going to account for it. So please see here, this is part of transaction number 6, where we had cash discount, we had trade discount, we had cash discount, and we had freight. Now, when you return those goods, you're not going to get any freight back, of course, but you're going to get some cash back or get some credit back. So the credit you're going to receive back is $1,000 minus the cash discount, because remember, you recorded it using the net method. So when you accounted for it, initially you recorded accounts payable under the net method. In other words, you recorded the net accounts payable. The net accounts payable means your purchase price minus trade discount minus cash discount was your accounts payable. So now you're going to get credit also for the net amount, means net of trade and cash discount. So the $1,000 quotation here is just before the cash discount. So that was after the trade discount already. That's before cash discount. In other words, you just have to account for $1,000 minus the 2%. So $1,000, 2% is $20. That means you're going to get a credit for $980. So debit accounts payable, your accounts payable, your liability is going down, and your inventory is going out. Very similar to the previous one. You see, credit inventory, debit accounts payable. Debit accounts payable, credit inventory. The first one didn't have any cash discount. The second one did. But they're both credit purchases, and for both of them, accounts payable and inventory are going to be at play. Under periodic, accounts payable and purchase return. Identical entries here for the previous one and this one. All right. So carefully see what's going on. Accounts payable is a liability. When you don't have to pay for it, pay it anymore, then it goes down. Liability going down is debit. Asset going out is credit. All right. Okay. Now let's deal with a sales return, the type of transaction that I was waiting for. All right. So look at the transaction here. It says refunded customer $500 for returned merchandise from sale on number 7. So on number 7, we had a sale. We made a refund back to the customer, $500. And number 7, the sale on number 7, remember, was a cash sale. So you're going to make a cash refund. The cost of the returned merchandise was $275. All right, so please check the transaction carefully. Refunded customer $500 for a return for goods sold on number 7. So on number 7, we had a cash sale. If the customer brings back part of the goods, we're going to give them cash back. So when cash goes out, cash is credit. What is debit? What's happening? Here, see, customer, refunds payable, debit, customer refunds payable, debit, and cash is credit. No use of accounts receivable because there was a cash sale. We're not going to reduce accounts receivable. We're going to give them cash back. So no accounts receivable is going to be credited. It's going to be cash. But debit is important. Debit is not sales return. We're going to see sales return under periodic method, but under the perpetual method, we call it customer refunds payable. Now, what does customer refund payable originate from? I'm going to say it later, because when we make a sale, we make an estimate. We make an estimate of the expected customer refunds payable. So we create that liability first, and then we pay it off. So remember, as soon as you sold these goods, or even sometimes before you sold the goods, you would have estimated the total amount of sales returns. So that would be a potential liability. So when you make refunds, you refund from there. So customer refunds payable, debit customer refunds payable, $500, cash is credit. And then you also, when the customer is returning some goods, those goods are treated like assets. So you're receiving some assets, and I'm assuming that the goods are in great condition, in excellent condition, and they're returnable, at least in returnable conditions. So you debit inventory for the 275 and credit estimated returns inventory. So these two journal entries have two items that are new to us. They're new. One is debit customer refunds payable. So you have to try to memorize that whenever there is a sales return, don't call it sales return, it's customer returns, customer refunds payable. Whether it's cash or non-cash, the debit is the same. Customer refunds payable for the for the amount selling price, and then estimated returns inventory is for the cost price. The fact that inventory is coming in, that's easy, debit inventory. But the credit is new, estimated returns inventory for the cost price. All right. Under the periodic, debit sales returns and credit cash. Sales return is a contra sales. It's easy. Sales is credit, sales return must be debit. Okay. So check for one final time. The $500 cash is going out. So cash credit, I think, is simple. Inventory debit is also simple, easier to remember. But this debit, the customer refunds payable, is like paying off a liability. So that's debited. And you're going to see, wait until we get to the adjusting journal entries, you're going to see how it originates, the customer refunds payable, how it originates. And then here, estimated returns inventory is credit. All right. That also is originated as part of an adjustment. So when you do the adjusting journal entries for at the end of the period, then you're going to see we create this customer refunds payable as well as estimated returns inventory. So here we are just knocking them off. All right. Now transaction number 11. Let's sell some merchandise on credit. Number 7 was a cash sale. This is a credit sale. So we're going to have this credit sale and then have some associated return. Some of these goods are going to be coming back. Also, the transaction is sold merchandise on account, $3,000, terms, FOB shipping point. The seller was responsible up to the shipping point, or we are responsible up to the shipping point, but you can still pay the freight if the customer requests. So FOB shipping point, trade discount 20%, 210 N30. 210 means you're going to receive 2% discount if you pay within 10 days, but if you pay beyond 10 days, you have 30 days to pay. The cost of these goods was $1,500. Perfect. So you must be expecting 2 journal entries. Remember, for every sale and sales returns, there will be 2 journal entries. So here, your first one is accounts receivable. It's a credit sale. So debit accounts receivable and credit sales for the $2,000, and debit cost of goods sold and credit inventory for the cost price. The first entry is at the selling price. Second entry is at the cost price. For every sale, this is going to happen. Debit cash or accounts receivable, credit sales, and debit cost of goods sold, credit inventory. Under perpetual. And under periodic, no surprise, debit accounts receivable and credit sales. Isn't it? Single entry, single journal entry, and simple journal entry. Well, so keep an eye on this. This part of this $2,000 is going to be coming back, and see how we treat it, how we deal with it. Actually, it's already happening right away. So here, transaction number 12, issued credit memo. So our customer has already decided to return some of it. So we issued credit memo to customer for merchandise with an invoice amount of $800 before cash discount. $800 was before cash discount, but after trade discount. That is sold in number 11. Cost of these goods was $500. Remember, was the total sales? The total sales volume, I mean, the total amount of the sale was $3,000. Of it, we had trade discount 20%, so $600 was off, then $2,400. So the $800 that has come back is part of the $2,400. So this $800 is off or after trade discount, but before cash discount. All right. See carefully. $800, then within bracket says before cash discount, and the cost of these goods was $500. So debit, again, customer refunds payable. See, the amount is not $800 anymore. Why not? It's $800, but you have to take the 2% off. So 2% of 800 is $16. So take the $16 off, and you're left with $784. So debit customer refunds payable again, $784. Credit accounts receivable. We're not going to give you cash back, so no cash credit. Credit would be accounts receivable. So our accounts receivable is going down, and then debit inventory for the cost. The cost of it was $500, and credit estimated returns inventory. Under the periodic method, you have sales returns, the amount after the discount. So both perpetual and periodic are using the net method. The net method is more customary. We're expecting the customer to take advantage of the discount. And when we are the customer, we also take advantage of the discount. So net method is what you're practicing here, but I'll also show you what happens when you apply the gross method. And I mean, it's up to you. You can use the gross method and still take advantage of the discount window. But what is customary, what is more relevant and more appropriate is that if you know that a company is going to take advantage of the discount, if that's your practice, that you always take advantage of the discount window, because if you pay within 10 days, sometimes 10 days, the difference between 10 and 30 days is only 20 days. And if you can save 2% in 20 days, imagine how much you can save in 360 days. So 2% in 20 days means nearly 36% in 1 year. So great saving, and that's why we assume that the cost of not taking the credit is a lot. It's very costly to not take advantage of the credit period, discount period. All right, so yeah, I was referring to cost of not taking the discount, not taking the credit. Okay, so debit customer refunds payable, like the previous return, sales return, but the amount is going to be the net amount, net of the cash discount of 2% and credit accounts receivable, and then here debit inventory and credit estimated returns inventory. All right. So that's our transaction number 11. So we have seen a cash refund on a sales return, and we have also seen a credit memo for a credit for a sales return. All right, now let's see the transactions, how we account for the payments. Then we had purchases, we had sales, we had cash purchases that don't require any more payment anymore because we've already paid for it. But we had remember we had a credit purchase and we had a credit sale, so we'll have to make payments for those. So that's what we have here. Number 13, paid for purchases made in. Number 2, how much was the purchase? The purchase was $2,000. Well, the purchase was for $3,000, then we had a return for $1,000. So we still owe them $2,000. So debit accounts payable, credit cash. Same entry under the two methods, under both methods. No problems there. We just have to find out the amount payable. Remember, original transaction, original purchase was a $3,000 one, minus the return. There's no discount in number 2. All right. So debit accounts payable, credit cash. I've shown that working here. How we go to $2,000. Now make the payment for the purchase you made in number 6, which was also a credit purchase, but which had cash discount, trade discount, and cash discount and returns. So the calculations are very important here. The original purchase price was $20,000 minus the trade discount $3,000, so that leaves us with 17, minus cash discount 940 leaves us with 16,660 plus 270 freight. So this is a repeat of a calculation that I've shown before. But now take off the amount returned. So the amount originally payable was 16,930. 16,930 was including the freight. Then we have the purchase return, which was 980. So the net amount payable is $15,950. That's the net amount payable. And once you know the net amount payable, the debit accounts payable and credit cash. Simple journal entry. Debit accounts payable and credit cash. But I think getting to the amount is difficult. But we already knew the 16,660. We knew the 16,660 and we knew the 270. So we knew the 16,930. We knew it. Then from 16,930, just take off the return. Or I think a much better way is to keep track of your accounts payable. Remember, when you purchased it, you credited accounts payable for 16,930. You credited your accounts payable for this transaction by 16,930. And then when you had a return, when you returned some of it, you debited your accounts payable by 980. So simply make them interact. Have them interact with each other. Accounts payable was credited by say $500, then was debited by $80, then it has a balance of $420. So I just paid $420. So don't be viewed by the rigor or so-called overwhelmingness of the calculations. Think straight. Think in simple terms. How much I owe you? I don't owe you $20,000. Give me my trade discount. So that's $3,000 knocked off. 17, then take off the cash discount, add the freight. So it was 19,300 and 16,930. 16,930 was what my bill was. And then I returned some goods and you gave me a credit memo for 980. So take the 980 off and your final amount payable is 15,950 or whatever the amount is, and you paid it off. Okay, so pay off what you owed for that purchase in number 6. All right, how do you feel? Accounting is a serious business, you know, and you're learning a profession. It's not just a job that anyone with 15 minutes training can take up. So people take 4 years here to just have a graduation in accounting. Then there would be 30 more credits in most states, including Alabama, to prepare for your CPA, because most states have now adopted the 150-hour credit requirement for the CPA for even to aspire to be a CPA. In France, it takes 7 years of schooling, 7 years of accounting before you get the license to practice accounting. All right, so but accounting is not that hard, I can tell you. What you have done, I mean, if I was smarter, many of you would be thinking that, well, Professor, you have been spending like 80 minutes on this video to talk about just a few simple transactions. Why not encapsulate them in 5 minutes? I can do that in 5 minutes. I'm sure many of you can too. What we have seen is journal entry for a cash purchase, for a credit purchase, for a cash sales, for a credit sales, and returns, and then payments. So that's the cycle. All right, so it's not a lot. All right, let's now make the payment here. Alternative, so I've also said paid the purchase made in 6 after discount period was over. Now this is my appendix. I added it. The textbook doesn't go that far. What I decided, I thought, okay, what if we do make the payment for the purchase? What if we pay too late to take advantage of the discount? So what if we pay after the discount window is closed? So take a read. That's number 14A, 14 alternative. Paid for the purchase made in number 6 after the discount window was closed. Net method was originally used. Guess what? To make life more difficult, that you originally used the net method. So you thought you were going to take advantage of the discount, and then you missed it. So now you'd have to pay more than what you thought your accounts payable was, won't you? Remember, you thought you owe me, say, $980, but now you're having to pay me $1,000, full $1,000. So how do you account for it? All right. So look at the calculations here. Your invoice price was 20, then $3,000 trade discount. That leaves us with 17, $1,000 return, leaves us with $16,000. Add the freight to 70, so 16,270. 16,270. See, I took the $1,000 off here. I didn't take off the 2% cash discount because we are not eligible. We're not eligible to receive it anymore. We missed it. So to find the amount payable, this one is not going to be identical to the previous calculation. The attempt here, the goal here is to find out the amount ultimately payable. So this is what we need to pay them. $16,270. But I've shown you that you can, there's a shortcut to get to the same amount. You can go back to the original amount payable, then add the discount. What you can do is, okay, let's work backwards. Let's say that, okay, how much I thought I owe you. So you thought you owed me $980, or whatever the amount, net amount after trade discount and after the cash discount. So after both the discounts, start with that and then add the discount, because you are not eligible to receive it anymore. So add the discount on the full amount and then take off the discount on the one that you return, on the ones that you return. So plus 340 minus 20. $20 is the 2% of the $1,000 that we returned, and 340 is the 2% of the $17,000 that we originally purchased. So that also lead us to $16,270. It's simple. 20,000 minus 3, 17 minus 1, 16 plus freight. All right, now I know that I owe you 16,270, but I don't know how to account for it because my accounts payable is not 16,270. It is slightly less because when I counted my accounts payable, I counted on taking the discount. All right, so accounts payable, it doesn't need to change. You can see accounts payable is left at what it was. Accounts payable doesn't need to be updated. So that's what you thought your accounts payable was, but your cash payment is higher. No problem. They're going to be happy. They don't care how much you think they don't care how much you recorded as the amount you owed someone. They care about the cash amount, the amount of the check. So you pay them the full amount here that you just calculated, 16,270. So credit cash 16,270, debit accounts payable the original amount, and then another debit is purchase discount lost. Purchase discount lost is debit. You can see debit means expense. We know that we missed an opportunity, so missed opportunity means expense, means cost. So debit purchase discount lost for the amount. And see that amount 320 is easy. What's the total discount on the 17,000? 340 minus the discount on the returned goods. You returned only $1,000 worth of goods. So in that 1,000, discount was $20. Total discount was 340. So 340 minus 20 is 340 minus 20 is $320. So that's the amount of purchase discount lost. Okay. See carefully. All right. So we made the payments for the purchases. Now we're going to receive the payments for the sales. And we're going to have one similar occasion where our customer inadvertently forgot to pay within the discount period. So they're going to pay us the full amount, and you'll see what happens to them. There will be something opposite to purchase discount lost. All right. So here we have a transaction saying they received payment for sales made in number 11. All right. It's a good thing. We're hoping to receive, we're getting ready to get some payment. So your full amount is $3,000 minus trade discount 600, 2,400 minus cash discount 48, $2,400. 2% is $48. Then the return goods. See, let's credit memo for returns. So 2,352 minus the credit memo for the returns, which is 784. So the net amount receivable is 1,568. It's easy. Just keep track of what's happening. Your total sales was $3,000 minus trade discount of 20%, $600. Then the cash discount, 48. So that was the original amount, 2,352. Then there was a return. Customer returned some goods. Remember, $800 worth of goods minus the discount, so 784. Take it off. So net amount that you can expect is 1,568. So receive the money, debit cash, credit accounts, receivable. Same entry under the two methods, perpetual and periodic. All right. Then receive the payment after the discount window is closed. This is what is Karim's addition or appendix. Well, let's see what's happening here. Go back Original sale was $3,000 minus the trade discount, and do not take off the cash discount. That's the easier way. $3,000 minus trade discount of $600 is $2,400 minus return of $800. Because this time the customer is not going to receive any benefit of the cash discount. They missed it. All right, so 2,400 minus 800 is 1,600, and from the 1,600, you expect all of it. So debit cash is going to be $1,600. You can see debit cash is $1,600, but our accounts receivable is not $1,600. That's the trouble, because we recorded accounts receivable using the net method. We thought our customer is going to be smart enough to take advantage of the discount period. So your customer is more like me. I miss a lot of these opportunities and pay probably more in penalties than on my groceries. Terrible. Anyway, so this is accounting and not about me. It's about the transactions. All right, so see the cash receipt is $1,600 here. The cash receipt on the previous one was $1,568. It was net of discount. Same transaction. That time, the customer didn't miss the discount window. So they paid $1,568. Now they'll have to pay the full $1,600. All right. So see, debit cash, credit accounts receivable for $1,568, but also credit sales discount forfeited. So this is like a profit for you. This is a revenue, an income for you. If you can forfeit people's discount, so the discount that the customer was thinking that, yeah, we were going to grab it, and now you forfeited it, or they forfeited it. They just foregone. So that the difference is your $32. And 32 is actually simple. The total amount is $1,600. On 1,600, 2% is 32. Why total amount is 16? The total amount was 24. But of the 24, they returned already. They returned $800 worth of goods. So $1,600, 2% is 32. All right. So same entry under periodic. You debit cash, credit accounts receivable, and credit sales discount forfeited. I didn't write it down here. All right. Okay, now we are closing. We're getting close to the last couple of slides. So now the adjustments. So you've seen how we complete the cycle: purchases, purchase return, purchase discount, dealing with freight, and making the payments. Sales returns, receiving the payment. Simple. Now the two adjustments, and that will be the end of it. So one adjustment is for any inventory shrinkage. See, under Perpetual, it is more likely that you're going to see inventory shrinkage, because you're recording every sale as a sale, and you're recording every cost as a cost of goods sold. So when you, for example, you've been selling these. So let's say I bought 12 of these, and then I sold 10. So based on my record, my computer, I should have 2 bottles left in my inventory. Tonight, 2 bottles. But what if I don't have those 2? Because in real world, it is possible that they could have been broken, they could have been stolen, they could have been damaged or something. So I don't have the 2. On paper, I do, but in reality, I don't. So that's called inventory shrinkage. That means there's a loss. So what happens when you have these losses? We load it to cost of goods sold. That is, cost of goods sold is a poor fellow. That any loss, we have seen that in job cost accounting, in under application of overhead, that if overhead has been underapplied, then you load it to cost of goods sold and make it bigger. So now we have inventory shrinkage. So we sold actually 10 bottles, but we are now recording cost of 12 bottles against the selling price or revenue of 10 bottles only. Also, debit cost of goods sold for the amount of the shrinkage, and credit inventory, because your inventory is gone. Inventory is lost. All right. Now under periodic, you can say no entry. Why? No entry, Because inventory shrinkage cannot be directly determined. What I say here, or what I see here, is that when you're using the periodic method, then you don't have real-time record of your inventory. Do you? You don't have a real-time record. You do periodic stock take after every 3 months or sometimes at the end of the year. So whatever is there is what is there. So your inventory, your closing inventory is based on physical count, is based on physical verification. It is not based on any computer program or anyone's papers. What you see is what you get. All right. So if I actually don't have the 2 bottles left, that means there will be no closing inventory. So I would have already put the whole purchase. Remember, I purchased 12 bottles, sold 10. So, but my whole purchase is recorded as a purchase, as an expense. Unless I have any closing inventory to reduce my cost of goods sold, then my purchase is my cost of goods sold. That's why under periodic, there is no need and there is no way to actually find out your inventory shrinkage or overage. If you find more, then that's all the better, isn't it? It is possible sometimes to have more. Like you heard some poor customers who have bought maybe 7 bottles, but they've taken delivery of only 6, and neither party was at fault, neither party knew what's happening. So it was an innocent mistake. So you now have 3 bottles. If you have 3 bottles in your closing inventory, you have that in a closing inventory. No one is allowed to take the spare bottle home. Okay? So that will reduce your cost of goods sold if you have an inventory overage. And the entry would be just opposite. Debit inventory under perpetual, credit cost of goods sold. Cost of goods sold will go down for the overage. And debit would be inventory because inventory is going to go up. All right. So that's the adjustment for inventory shrinkage or overage. And the final one, the final slide is this. It's also an adjustment. This adjustment is for customer refunds. So at the end of the period, remember, we've been selling goods throughout the year, and now say it's December, so we have to close our books. But customers could have 60 days, 90 days, even Walmart nowadays allow up to 90 days on some occasions for you to return. So things that you sold all the way in October, November, and December are likely to come back. And some of it could come back in January, February, and March. So you have to, conservative accounting demands that you have to account for those expected returns. So you have to reduce your revenue by the expected amount of refunds, expected amount of returns at selling price, and you have to increase your inventory by the expected amount of cost of those goods. All right, let's say I'm expecting a total $500,000 or $500 worth of returns. So that $500 is not actually my sales. That's like sales returns or expected sales returns. But of those 500, there'll be some goods there. Let's say the value of those goods is $190. So I will include that in my inventory as expected inventory. All right, so let's read it. What you see, customer refunds payable and estimated returns inventory. Estimated returns is $1,000 and the cost of such merchandise is $450. All right, so there are going to be 2 journal entries here on a perpetual. One is debit sales. So reduce your sales by the $1,000 because $1,000 worth of goods are coming back. So debit sales and credit customer refunds payable. So this is why the customer refunds payable is created. That's why it's born. Can you see? Credit, a liability is born. Credit customer refunds payable for $1,000. And then this $1,000 has a legacy. $450 would be the goods, would be the cost of goods. So that's a good news for me. That's estimated returns inventory, very much similar to inventory. So in our financial statements, in preparing our cost of goods sold or actual balance sheets, you'll see in trial balances, you'll see inventory as well as estimated returns inventory, both at the beginning of the period and at the end of the period. So estimated returns inventory is going to be 450. See, asset, similar to inventory, debit assets, and credit cost of goods sold. You reduce your cost of goods sold. So we reduce our sales and associated costs at the same time. Our sales go down, unfortunately, by $1,000, but our cost also goes down by $450. So we miss on the $550 of profit. Under periodic, debit sales returns or expected sales returns, and credit, customer refunds payable. So sales, instead of debiting sales, we debit sales returns. And no account for the inventory. Because inventory, if they come back, we're going to find out, we do physical verification of inventory. We do a stock take on a periodic. Well, we do a stock take under perpetual as well. So don't get me wrong. And I don't want you to have the wrong impression that when you have real-time inventory, book-based inventory, we don't need to physically check. We actually do stock take. We take our stock to see whether the books match with the reality. And that's what leads to inventory shrinkage or overage under perpetual too. All right, so here we debit sales returns and credit customer refunds payable for the $1,000. All right, so that's about it. A whole set of journal entries under periodic and perpetual systems, or perpetual and periodic systems, whichever order you follow. Important thing is the use of inventory a lot, you've seen. And I'd like you to remember at least these couple of things, that when we pay for freight under perpetual, we record it to inventory, especially inward freight. Well, not especially, only in case of inward freight. So you're paying for freight inward freight, but you're debiting inventory, not debit freight in. Then you have sales. Every sales and sales returns has two entries. We record the sale as well as the cost of it. And when we have a sales return, we record the return at selling price as well as reduce the cost of goods sold for the cost price. So these are important characteristics of the perpetual inventory system. All right. And perpetual, I want to coinage it as real-time inventory system. Because perpetual means permanent record. Well, any record could be permanent. But what is important here, what makes it, it's not, it's different not because it's permanent. The other one is not temporary. It's different because it's real time. You don't have to wait until the end of the quarter to know how many units you have in stock, to know how much your total cost of goods sold is. So actually, from every transaction, you can calculate your gross profit, because you have sales as well as cost of goods sold. So at the end of every day, or at the end of every transaction, every sale, we know how much margin we have. But on a periodic, we don't. Because you have the sales, then you have purchases. There may not be the same number of units that we're selling, the ones that we're purchasing. Purchase could be lagging behind, or there may be no purchases. If we have had stocks, our shelves full, then we would not make any purchase, but we would still sell. So having a sense of your profitability is a bit remote, a bit delayed, lagged in periodic inventory system. Perpetual gives you much more real-time sense of profitability, because we already we know a total amount of cost of goods sold and sales revenue every day, right? Real time. Okay, so thank you so much for your attention. Please go through the slides again, go through the video, pause them, stop them, look at them, and also wait to see if I can do a video on solving a problem, from chapter 5. I have a plan to go over a series of transactions, in a similar series of transactions based on a problem from chapter 5 within a couple of days. All right. I hope you have a good evening, good night. Enjoy watching these videos. All right, and enjoy accounting. Thank you. Bye-bye.